So, on the surface, everything looks great, right? I mean, the stock market is hitting all-time highs. Unemployment is super low. But does anyone else feel like something's off? It's like we're all standing on what seems like solid ground, but you can just feel these little tremors, these fault lines starting to crack right under our feet. And this right here, this is a huge part of what we're talking about today. You've got this massive disconnect between the story the headlines are telling us and, well, the reality a lot of people are actually living through. So while you see all this celebration about a booming economy, there's this quiet credit crisis just bubbling away right under the surface. Okay, so let's dig into that first major fault line. You've probably heard this phrase a million times, right? The strong consumer. The idea that our spending is what's keeping the whole economy afloat. But what if that strength isn't real? What if it's just an illusion and it's all being powered by, you guessed it, an insane amount of debt? Just look at that number. Let it sink in. We're talking about total household debt in the US exploding to $18.6 trillion. That is the highest level ever recorded. Ever. I love how one analyst put it. He said debt has basically become the duct tape holding the whole economy together. And let's be clear, we're not talking about government spending here. This is happening at your kitchen table, at my kitchen table, at the household level. Now look, not all debt is the same, right? You can kind of break it down with a classic framework: the good, the bad, and the ugly. The good? That's like mortgages, debt that's tied to something that's hopefully growing in value. The bad? Think student loans. It's just this heavy weight on millions of people, and it's really hard to get rid of. But then you have the ugly, and that's credit card debt. That's the really dangerous stuff, and it's growing at a rate that should make all of us a little nervous. And this is where you see the real danger zone. We're looking at the share of credit card accounts that are seriously delinquent. We're talking 90 days or more late. That number has shot up past 12%. You know the last time it was that high? 2008. Yeah. And when you've got average interest rates hitting over 21%, this isn't just a little red flag. It's a full-blown siren. All right, let's move on to our second fault line, because this story just keeps building. This problem isn't just happening on Main Street. It's on Wall Street, too. I mean, the stock market is supposed to be this reflection of how the economy's doing, right? But lately, it just feels totally unanchored. For pretty much all of financial history, markets were tied to real stuff. Earnings, cash flow, actual economic data. But now, it feels like that anchor's been cut, and the whole thing is just drifting. And hey, don't just take my word for it. This quote is from Michael Burry. Yeah, that Michael Burry, the guy from The Big Short, the one who famously predicted the 2008 crash. He basically just shut down his hedge fund, saying the market has stopped making any sense to him. I mean, when a guy who literally built his entire fortune on trusting the numbers starts to wonder if gravity even applies anymore, that is a massive, massive warning sign. So, if the fundamentals aren't driving prices anymore, then what is? Well, the answer seems to be this thing that used to be kind of on the fringe of economics. It's called behavioral finance. And the idea is actually pretty simple. Markets aren't these perfect rational machines. No, they're driven by people, by us, by our psychology, our emotions, the stories we tell ourselves. And right now, it really feels like that is the main operating system for the entire market. And what's the core belief of this new operating system? It's super simple. Buy the dip. You've heard it, right? What used to just be a trading strategy has somehow morphed into this core, unquestionable assumption that stocks only go up. Every single downturn is seen as a gift, like, oh great, a sale. It's a mindset that just reinforces this total detachment from actual value and basically turns investing into a game of momentum, not analysis. Okay, for our third and final fault line, we have to pull the camera back. Let's zoom out to the global stage. See, for decades, the entire U.S. financial system has been propped up by two things: international trust and a constant flow of foreign money. But that trust, it's starting to quietly erode. And one of the most important money taps in the world is starting to run dry. For about 30 years, Japan has pretty much been the world's ATM. It worked like this. There was this thing called the yen carry trade. Big investors could borrow money in Japan for basically zero interest. Then they'd take all that nearly free cash and go buy stuff somewhere else, like U.S. government bonds that paid them a much higher return. It was a simple, super profitable trade that funneled trillions of dollars into the U.S. and helped keep our borrowing costs way lower than they should have been. But now, that whole game is changing. In 2024, Japan raised its interest rates for the first time in 17 years. All of a sudden, that free money trade,
is it free anymore? The simple math that pushed trillions of dollars out of Japan for decades has completely flipped on its head. And now that money is starting to go home. So one of the biggest, most reliable buyers of US debt is walking away from the table.
And it isn't just private investors in Japan either. Take a look at what central banks around the world are doing. They're quietly diversifying away from the US dollar. What does that mean? Well, 20 years ago, the dollar made up over 70% of their big pile of savings, their reserves. Today, that's fallen to 58%. Now, this isn't a panic, it's a slow, strategic retreat, and it's a huge sign of fading long-term faith. So you might be asking, where's that money going instead? A big chunk of it is going into gold. I mean, look at this. Central banks are buying gold at a pace we've never seen before. For 3 years straight now, they've bought over 1,000 tons. That's more than double what they used to buy. And again, this isn't a panic move. This is strategy. They're buying insurance. They are hedging against a future that they clearly don't fully trust. Okay, so let's tie this all together. You've got consumers who are completely propped up by record-breaking debt. You've got a stock market that's being driven by feelings instead of facts. And you've got global trust in the whole US system starting to fade. When you put all those threads together, a single pretty powerful theory starts to emerge. It's something called the greater fool theory. Here's the basic idea. The price of an asset, any asset, doesn't really have to be connected to its actual intrinsic value. The only thing that matters is that you believe there's a greater fool out there who will come along and buy it from you later for an even higher price. So value isn't based on anything real. It becomes completely dependent on just finding that next person who's willing to buy in. Now, this quote was actually first used to describe Bitcoin, but man, it works as a perfect metaphor for the whole system we've been talking about. Think about it. From consumers who are depending on getting that next credit card to finance their spending, to investors who are depending on the next buyer to push stock prices even higher, the basic logic is exactly the same. So when you really step back and look at the big picture, our entire economic system, from the individual household to Wall Street, all the way to the global markets, it seems to be relying on this one single belief, that there will always be someone else, somewhere, willing to buy in at a higher price. And that leaves us with one last kind of scary question, doesn't it? What happens when we finally run out of fools?